Housing updates are usually lagging by 1 to 2 months in time. So today, let's look at some of the leading economic numbers. Here are some of the headlines today on April 29th, 2022. Dow dropped almost 1,000 points, Nasdaq more than 600 points, and being the last trading day in April, it is one of the worst 4-month starts to a year in decades. Hi, this is Michael Chu of 7M Realty in Fremont, Silicon Valley. And if this is your first time on my channel, please like, comment, and subscribe. We give you the latest housing developments as well as real estate happenings locally in Fremont, Silicon Valley. So that was a lot of bad news on the trading front, and perhaps one of the triggers was that it was reported this morning the U.S. economy shrank 1.4% in the first 3 months of 2022. It is the first time since the pandemic started in 2020. This shrinkage sprouted the fears that a recession is coming. And a recession occurs when the economy has 2 consecutive quarters of negative growth. Of course, economists aren't drawing a straight line between the recession and this GDP report. There are many factors at play here. One of them, which impacts real estate, is the Fed raising interest rates. It is reported that the Fed is expected to raise the Fed fund rate by 50 basis points. When the Fed Reserve makes it more expensive for the banks to borrow by targeting a higher federal funds rate, the banks in return pass on the higher cost to its customers. Interest rates on consumer borrowing, including mortgage rates, tend to go up. So Bank of America, Goldman Sachs, and Wells Fargo stock prices dropped to below a year ago. I use the bank stock as a gauge to see how confident the market is regarding finances in general, which includes mortgage financing. Today's headline also shows that Netflix is going through layoffs and spending cuts. I came across this very interesting study in Fortune magazine. It says the odds of a home price declining hitting your local housing market. We'll get into shortly on that. Basically, right now, the Fed is announcing that they're going to be increasing the federal funds rate at each of their meetings this year. Their next meeting, which is May 2nd, Wednesday, they basically will be doing this to target inflation. They're going to be increasing the federal funds rate to curb inflation rate. It's saying that the Fed plan is put upward pressure on interest rates until price growth relents. So right now, the street is forecasting for a 50 basis point increase by a probability of 96% at their next meeting because the Fed has announced they're going to be raising rates at practically every single meeting this year. There's a lot of talk regarding how that's going to affect the housing market because the increase in the Fed funds rate have an indirect effect on mortgage rates. And it's not a direct correlation, but it can increase mortgage rates, and that's one reason why we're seeing mortgage rates increase greatly so far this year. We see early signs of market slowing down, a decrease in pending home sales, in the existing home sale, and also a decrease in number of new home sales in addition, and a decrease in the amount of purchase application for loans. So on top of this, Redfin announced that they were seeing a 4% reduction in their home demand index, its number of home showing requests. We're starting to see some earlier indications that our housing market is slowing down. So the latest mortgage rate on a weekly basis just announced this morning that the average last week was 5.1%. There's a chance that the economic shock caused by the soaring mortgage rate could see home value fall in some overpriced market. And it says here to understand which regional markets in the U.S. might see a price decline. The Fortune study is an assessment of close to 400 metro areas across the United States. Tells you the cities they are at the greatest risk. And here's the article actually. I will include the URL here so you can read it more in detail on your own. This is a very interesting and detailed article. Let's take a look. Enlarge this a little bit. So, historically speaking, that inflation fighting playbook is particularly hard felt in the housing market where spiking mortgage rates can quickly price out home buyers. And that's already starting to happen. On Thursday, the average 30-year fixed mortgage rate hit 5.11%, up from 3.11 in December. A borrower who took out a $500,000 mortgage at a 3.11 rate would owe $2,138 per month. At a 5.11 rate, that monthly payment on a 30-year mortgage spikes to $2,718, and that's close to $600 difference. So it could make a difference whether a borrower or a buyer actually gets into a home or not. So continue on. While swift move up in mortgage rate is undoubtedly putting downward pressure on the housing market, it doesn't mean home prices are about to crash. In fact, every major real estate firm with a publicly released forecast model, including Fannie Mae and Zillow, still predicts home prices will climb further this year. Wow, right? And that said, industry insiders tell Fortune there's increasingly a chance that the economic shock caused by the soaring mortgage rate could see home values fall in some overpriced housing markets. So the interesting thing here is it's not a decrease in price, but it could be in some overpriced housing market. So it's not all over. So to better understand which regional housing market might see a price decline, Fortune reached out to CoreLogic. Well, CoreLogic is one of those data aggregator for real estate, and they accumulate a lot of data. CoreLogic provided assessment of close to 400 metropolitan statistical areas. CoreLogic, which ranks number 952 on the Fortune 1000 company, put housing markets into one of 5 categories based on the likelihood that home prices in that particular market are to fall over the coming 12 months. And here are these groupings. So the elevated is over 40% chance of a price dip, and high at 30 to 40% chance, medium at 20 to 30, low at 10 to 20, and very low at 0 to 10% chance. Now here comes the interactive chart. Let's zoom in a little bit. So as you can see, most of the color on here is either very low or low. Maybe there's also some medium level risk. And there's only a small handful area that's elevated. So we can take a look at these red spots. So this is the Hartford, Connecticut area. This little one here is in Maine. There's a few in Michigan, the Kalamazoo area. This is Muskegon in Michigan also. And here's Hawaii, Honolulu. And then northwest, there's the Salem, Oregon area, the Olympia in Washington, and Mount Vernon, Washington area. So those are the only few that are in the red, very high or elevated risk of price dip. The rest of area, if we hone in on California, you can see most of these are in surprisingly Bay Area and all the surrounding counties, maybe a little bit contrary to our intuitive popular belief. Let's move on. Among the 392 regions housing market that CoreLogic measured, it puts 86% into the very low or low likelihood of a price decline. It puts 10% of market into the medium and 1% in the high grouping. Meanwhile, CoreLogic places only 2% of market into the elevated group. The markets in the elevated group, the highest odds of pricing correction include Hartford, Kalamazoo, Lewiston, Maine, and Mount Vernon, Washington, Muskegon, Michigan, Olympia, Washington, Salem, Oregon, and Honolulu. So even in the face of soaring mortgage rates, CoreLogic still thinks the chance of prices declining in 2022 are fairly low. The real estate research firm points to the mismatch between inventory and strong buyer demand. That's also reflected in its national forecast. Over the coming 12 months, CoreLogic predicts U.S. home prices are poised to rise 5%. That's marked deceleration from the 19.8% jump posted over the past 12 months. So this is one of the key information. It's basically saying that yes, price is coming down, but it's not coming down in the real term. It's just coming down in the acceleration of the rate of increase of prices, but not in the price itself. So they go on and say, however, that it doesn't mean CoreLogic views the ongoing housing market boom as healthy. CoreLogic also calculated whether local income level could support local home prices, and the finding is again a little bit surprising. CoreLogic says 65% of US regional housing market are overvalued, and that includes every major market in states like Arizona, Florida, and Texas. Surprisingly, California is not included in here. Just 9% of regional housing markets are what CoreLogic deemed undervalued. 26% gets its normal label. So let's take a look at this map here. Zoom in a little bit. The red is the overvalued. Almost all markets that they're measuring are overvalued. I guess it's no surprising, but of course, it almost looks like the state of Arizona, Southern Cal, Northwest, most of the states and region throughout the Midwest and the mountain region, Texas, Florida. We'll be doing a series about why California are moving out to different Sunbelt states and all that. Look at this chart. The way to interpret this is the housing prices according to the local salary or income that people are making. Is that a sustainable price? So as you can see, most of the red area, you can think of it this way. People came from out of the area. They bought the house for cash, and it's not matching up to the local income level. And that's why these places are all red. If you think about local people like resenting outside or out of state people coming in with cash to buy up property, that's what these most of the red areas are. So if you're in the purple, you're basically in balance. This is the normal label. So the reverse is true in where it says undervalued. That means that the local income can support the level of housing prices. So again, these are actually more on the exceptional side. So in this case, Bridgeport area is undervalued on the East Coast. And then over here, it's New York, Elmira. And then over here in Georgia, Alabama area. And then in Michigan, there's several communities, areas that are in that undervalued range. Now, because we are in California, let's hone in a little bit more on the California side. The whole Bay Area undervalued. Consider our housing prices is number one in the country. Still, from this measurement, it says undervalued, which means the personal income side is actually up to par in supporting the home prices. Surprise, surprise. Places like Salinas or the shoreline south of Bay Area, this is actually overvalued. And this is Sacramento, Roseville area, overvalued. Yuba City in California, this is also overvalued. So with that type of metrics, Southern California, most of it is overvalued. And the rest of the measuring area in California seems to be either normal or undervalued. I thought it was interesting to bring this type of insights to you, just a different way of looking at housing market. Now that we went through that, let's go over the local market updates. I've done this last week, But if you can look at this number, median price at 1.53, and the days on market still 8 days. So these are virtually no change from last week. And looking at over here, it also is no change at 93. That's basically saying 15% overbidding is the common in Fremont. So locally, we're seeing the softening of market. Instead of 17, 15 multiple offers, we're now seeing like 3. Personally, I had one buyer who competed against 17 offers about 3 weeks ago, and this week it was only 3. We didn't get it, but still, the number of buyers out there seems to be reduced by a lot after about 3 weeks' time. It's probably in the 20-25% range that's left. The 75% kind of just either sitting on the sideline or went out the window because the higher rate at this point. That's the current market update from a current news standpoint. So it's a little bit forward looking, a little bit of backward looking on data. We do this every week, bringing you information and knowledge so you could be informed to make decisions on your housing. So to finish it off, I would just include a few more pieces that are like comments from around the country on this topic. So in state of Washington, it says here in Washington, a lot more inventory is coming on the market. Sellers trying to get out at the top or just the usual spring uptick, not sure yet. And then in Kentucky, someone says definitely seeing more price cuts and longer time on the market. Homes that are priced well, comparatively speaking, are still selling within a week or two. Then in Riverside, Southern California, home prices are being dropped, especially homes in the $700,000 to $1 million range, being seen as little as $25,000 to as much as $100,000 cut in Southern California, Riverside, San Bernardino County, and I believe our inventory is currently up from a year ago. What's happening in local market in Santa Clara, in Silicon Valley, as well as many things that are happening around the country. So changes are taking place. Stay tuned, and we'll bring you more of these interesting information. So if you have not done so, give us a subscription below and like a little bell. So next time when we're doing these uploads, you'll be informed. And until next time, let's make it a great day.